It's August 2026, and what we have seen this year has been another strong year by equity markets. The Standard & Poor's 500 is sitting near record highs, and all of this has occurred against a backdrop where there's concerns about the supply disruptions in the Middle East, continued elevated inflation, and underlying all of this has been a rampant degree of expenditure on the build out of AI. So where are we, and where do we see the portfolios here at Washington Crossing headed? I'm Kevin Karan, Co-Chief Investment Officer at Washington Crossing Advisors. Thank you for joining me. We have 6 reasons why we believe that the portfolios that we're managing under our quality style are performing well. Number 1, we know that each company in both the Victory and Rising Dividend portfolio are graded high quality based upon our metrics of quality, which I'll talk about in a minute. Number 2, we see positive operating results from all of the companies in the portfolios, both Victory and Rising Dividend. We see that the income that's being generated now is significantly higher, especially for Rising Dividend versus the Standard & Poor's 500. For example, there's a 2.3% dividend yield for the Rising Dividend portfolio, and that compares very favorably to the Standard & Poor's 500 yield, which is plunging to near record lows, or essentially record lows, of 1.1% or lower. Number 4, we understand the quality style, and we know how it's expected to perform. We understand that during very strong bull markets, that the quality style will tend to lag, and it tends to make up ground in normal or more challenged markets. And over time, we expect to see quality deliver strong results, especially on a risk-adjusted basis. And we know that the portfolios today are performing in line with the quality benchmarks that we set for them. Number 5, when you look back over a longer period of time, what you're going to see are very strong results, especially adjusted for risk. And number 6, when we look at valuation points today, we're mindful of the fact that the valuations for quality companies, many of which have been essentially ignored by the market, are now trading at prices that are very, very attractive from a historical basis. So when we put all of these together, we think that there are significant reasons why we should continue to stay the course. What we have here are quality portfolios, and they're designed to perform like quality. Well, what do we mean by quality? Well, we're looking for companies that have low debt, that have profitable assets, and are as consistent as the day is long. These traits tend to make a portfolio that is more predictable, more flexible, and more durable. This is something that's extremely helpful, especially for people who are in their pre or post-retirement years, who not only need growth and not only need income, but also need some answer for the defense side of the equation. It's very important to have not only an offense, but a defense. And our argument is that the popular indices out there have no such defense. So the opposite of quality would be companies that tend to be higher yielding, that are over indebted, that are financially engineered, that are overly complex, capital intensive, or commodity businesses. These are just not the kind of things that we want to own at Washington Crossing, because they create risk in a portfolio that can bite you at exactly the wrong time. These kind of companies show up in different ways than the popular indices. We understand this. The portfolios are built for long-run capital appreciation. They're not built for chasing the market. And because we look for growing, profitable, well-capitalized companies that have low debt, profitable assets, and are consistent, we expect to lag in strong bull markets. We expect to lead in sideways or down markets. There's a pendulum here, and it swings back and forth. And what you can see is that the kind of companies that we own, quality companies, they tend to be a little bit like insurance. So if you go through a period of time, like we have been for the last 3.5 years, where more than 80% of the returns for the Standard & Poor's 500 have come from above average risk stocks or low quality stocks, it's easy for markets to effectively give up paying for their insurance. There's not a lot of concern by markets at the moment about risk. And one of the things that we find in markets that is exploitable over time is the tendency for markets to underestimate risk and therefore underprice safety, especially during a bull market, such as the one we're in. So the whole idea is to think about owning companies through thick and thin that are able to have greater durability, greater flexibility, more predictability in a market that is focused more driven by greed, such as the environment that we've been in today. We understand that quality is going to be overlooked. On the other hand, when a market goes the other way and risk is reintroduced, then all of a sudden quality can look very attractive. And when you put it all together over a long period of time, it's our contention that the returns among high quality companies will be more durable as that factor tends to persist longer over time. Here you're looking at how we judge quality specifically. We grade every company in the United States, or the top 1,000 anyway, like students' grades, A, B, C, D, and F. And we grade them along 4 dimensions. So here you see debt in terms of the capital structure of a business. And you're going to see that as you move from A to F, the amount of debt in the capital structure increases essentially 8-fold. And this engenders risk that shows up as unexpected losses, particularly when things are not going well. All you have to do is think back to the financial crisis and you'll understand what that tends to look like. Number 2, we're going to grade companies in terms of profitability. And the profitability grade is going to be based on assets, not equity. We do this because ultimately generating a high return on assets is a difficult thing for companies to do, and we find that if you have companies that have a higher return on assets without the effect of leverage, then what you can end up with is a company that tends to persist better, especially when things get difficult. And in the last 2 columns, what we're looking at is the degree of volatility in the earnings stream, or I should say the consistency in the earnings stream, and the related volatility of the stock price. And as you might expect, as earnings or profitability becomes less consistent, so too the stock becomes less predictable. So ultimately, if you have these 4 dimensions where we're thinking about debt in the capital structure, we're thinking about the degree of profitability, we're thinking about consistency of the profitability in the business, ultimately these kind of measures lead us to what we find to be companies that express very strong defensive characteristics alongside a good offense. Here you see an interesting story. So what we've laid out here are multiple cycles going back to 2004, where we're charting the periods where high quality, the kind of investing that we do, tends to outperform low quality, and other cycles, such as the one we're in today, where low quality tends to outperform high quality. And what you're going to see are a couple things. Number 1, since early 2023, we have been in a cycle that have favored lower quality or higher risk stocks. And we're beyond 37 months now. This is a longer cycle than average. Typically, the typical cycle is about 24 months. But there are signs that this is starting to change. We've seen a couple spurts whereby lower quality, higher risk stocks have pulled back, and there have been significant moves forward by higher quality style type companies. This happened in January, and it just happened again over the last couple months. So as we go through the next few months, we wouldn't be surprised to see a leadership change. Number 2, when you look at across all of these periods, you're going to see something interesting. It turns out that the tortoise actually does beat the hare. The return on average since 2004 has been 11.6% for, let's call it the tortoise, the high quality return type companies that we invest in. And for the lower quality companies, let's call the hair, we end up with a 9.6% return. This cycle, we've seen the lower quality companies return about 77% versus 38% for the higher quality tortoise-like companies that we tend to own. It's very important when you put all of this together to recognize that the returns during shorter periods of time can be very attractive for the hair, as has been the case the last few years. But measured over a long period, cycle in, cycle out, what you'll find is that the returns have been better actually for the tortoise, so the tortoise does beat the hare. But I'll press it and go even further. When you look at the risk, what you see is that the annual risk, the volatility of the tortoise at 13.9%, the high quality returns, is just about half of that of the sometimes more exciting hare returns with a volatility there of 27%. So if we were to divide the return by the risk to try to answer the question, what return are we getting for every unit of risk we're taking, what you find is 11.6 divided by 13.9, return divided by risk is 0.83. Do the same thing for the hare, it's 0.36. So high quality, the return per unit of risk at 0.83 is significantly better than the risk-adjusted return for low quality. Now here, you can see a similar story, but this is now playing out in the bond market. I'm showing you this because what we see in equity markets oftentimes gets echoed in other markets, and I'm showing this so that we can see that there is symmetry between different markets. And what we've done here is we've plotted the difference between high yield bonds and a treasury bond. We've drawn a line, a dotted line, we're going to call that the greed zone. And what we see here is today we're at 2.67%. That's the difference in spread between the high yield bond index, high yield bonds, and treasuries. It's a very low level. And what you're going to see there is that during periods of time where you're in that greed zone, there tends to be a lot of liquidity. Investors are willing to take on risk. They're willing to take on investments without necessarily asking for a lot of compensation for the risk taken. But what you're going to see is that eventually investors do tend to ask for compensation for risk taken. And what you're going to see is that when we rise out of the green zone, which we typically do, what you're going to find is that the equity market also comes under pressure. And we're going to argue that during those periods of times, the higher quality, A quality type stocks, the tortoise essentially, is going to tend to do better than the riskier stocks. And so here from 2000 to 2003, for example, as spreads widened, we saw a 47% decline in the S&P. When we go from 2008 to 2009, the financial crisis, we saw a 55% drop in the S&P 500. During the European debt crisis, we saw a rise in spreads for corporate bonds, high yield bonds, S&P down 18, and it goes on and on. The main point here is that we are at a period where investors are not asking for a lot of compensation for the risks taken. We see it in premiums in the high yield market, we see it in premiums in the equity market, and we don't expect this situation to last indefinitely. So here we are. We're more than 37 months into a cycle that has favored high risk. We're more than 37 months into a cycle that has favored low quality. We know that in terms of the historic cycles in the quality measures that we track, we know that this cycle is getting fairly long in the tooth. So going back to the beginning, there are 6 reasons why we think the portfolio is positioned well today. Number 1, every single company in the portfolio is graded by us either an A or B. No C's, no D's, no F's. Essentially high quality. These are companies with low debt, profitable assets, and consistency. Number 2, the companies are generating positive operating results. The average 12-month forecast EPS growth, for example, in the rising dividend portfolio is over 15%. All 33 companies are expected to see earnings growth over the next 12 months. This is all based on Bloomberg analysis of analyst expectations. And the range of growth is anywhere from 2% to 47.7%. Number three, the portfolio rising dividend, for example, is producing much higher income now than the S&P 500. As the yield on the S&P 500 falls to 1.1% or lower, the 2.3% yield for rising dividend generates more than double the income for every dollar invested than a dollar that's invested in the S&P 500. Number four, the portfolio is performing in line with an appropriate benchmark, a benchmark that tracks high-quality companies, a benchmark that we know has generated single-digit returns for the last 2 years or so. And we understand that the portfolio is designed to perform in this manner so that when risk eventually does reassert itself in markets, the portfolio is positioned well for whatever comes. Number five, a very strong risk-adjusted track record over time. We've been in a risk-on cycle. Over a long period of time, we've had many risk-on cycles. We've had many risk-off cycles. And as the table earlier shows, the tortoise ultimately does beat the hare, especially on a risk-adjusted basis. So for us, the idea that this strategy, a strategy focused on quality at a reasonable price, tends to work over time is very strong evidence to us. We don't think that this concept is dead. And lastly, given where markets are trading, given valuations for the S&P 500, given where valuations are for many stocks, we're finding very good value among companies that have essentially been overlooked the last few years. So for investors who are still looking for a defense, who are still looking for an offense, for investors who are looking for income, for investors who are looking for growth of income, for investors who are looking to make sure that their portfolio is put together in a way so that it's predictable and durable and flexible, we still think the Washington Crossing high quality style of investing is very, very viable today. So there you have it. We have a lot of things going on. The market has been in a very strong bull market the last few years. We understand that AI has captured everyone's attention. We know that this is a mega capex cycle that's driving profits and stock prices, but we also know that cycles go both ways. We believe that at some point the pendulum will swing. At some point, lower quality, higher risk stocks will give way to higher quality, very well valued stocks that are generating substantial amounts of income. Thank you for joining me. I invite you to visit our website at WashingtonCrossingAdvisors.com. And from me and the rest of the team here at Washington Crossing, we hope to see you next time.